Welcome to the deep dive. We've got some really interesting material here today. Our mission, essentially, is to unpack the latest results from SBFC Finance Ltd. That's their Q2 and H1 for fiscal 26. And we're focusing specifically on their niche secured lending for MSMEs.
Exactly. And the core challenge that management themselves talked about is this balancing act. They need to nail the next decade, the big strategy, the growth plan, but at the same time, they absolutely have to get the next quarter right, which is all about the day-to-day, the risk management, the execution on the ground. So we're going to look at how they're managing that tension.
Yeah, and that tension pops up right away, doesn't it? You look at the headlines. I mean, they've basically doubled quarterly profits since listing. Profit after tax up 30% year on year, hitting 109 crore, which sounds fantastic. But then management also describes the current credit scene as a chaotic bazaar, lots of noise, lots of risk. So the big question for us is, how do you pull off those kinds of profit number when the environment feels so tricky?
Right. And to figure that out, I think we need to sort of pull out the telescope first. Look at the long view, the decade view. We need to understand the sheer size of this opportunity in India's MSME lending space.
Okay, so their focus, their sweet spot is what? Loans between 5 lakhs and to 30 lakhs aimed at these smaller MSMEs.
That's it. And it's a huge market.
Hmm.
But crucially, it's very fragmented, lots of small players, which creates a real opening for a specialist like SBFC. The total size of just that specific loan segment, it's estimated at around 4 trillion right now.
4 trillion. That's a massive number, but it's the growth rate that really catches the eye, isn't it?
Absolutely. Historically, this segment, it's grown at a 24% compound annual growth rate, a 24% CAGR. Just think about that for a second. That means the market has effectively doubled in size every 3 years. Pretty consistently, too. Management now feels, comfortable projecting a, let's say, safe 20% CAGR going forward.
20%.
Yeah, which still means they expect the market to double again from 4 trillion to maybe 8 trillion in about 4 years.
Okay, so 20% is still incredibly strong, especially given that chaotic, bizarre comment. But if history was 24%, why dial back to 20%? Is that purely the risk buffer? Factoring in like political stuff, climate stuff?
I think that's a big part of it, yeah. It feels like prudent risk management, building in a bit of a cushion. But they also point to the bigger picture, India's overall macroeconomic stability. That's the main tailwind, right? You've got relatively low inflation volatility these days, which generally means low interest rate volatility, and that tends to smooth out growth volatility too. They had this great line, something like, "It's not the quantum of the move, but the volatility that kills you."
Okay. So less wild swings make it easier to plan and grow steadily.
Precisely. Remove the extreme volatility and you can build for consistent performance.
And that stability lets them target those high returns. Which brings us back to the performance metrics and that damn thing is working moment they mentioned. Must be the return on equity.
Has to be. Yeah, the headline numbers really show they're translating that market opportunity into solid results. Assets under management, their AUM, grew 29% year on year, hit 9,938 crore. And actually, they mentioned crossing the 10,000 crore mark just after the quarter ended in October. So good momentum there.
Okay, and the profitability metric, they were so buzzed about 14.09% return on equity ROE this quarter. Just remind us, why is ROE so important, and is 14% really that good for an NBFC like this?
So ROE basically tells you how well a company is using shareholders' money to generate profit. And yeah, 14% for a specialty lender like SBFC is definitely strong. It signals that their underlying business model is working efficiently. That Edison quote they used, "the damn thing is working" moment, I think it captures that feeling. The structure they put in place, post-listing costs, pricing, risk controls, it's proving itself out. It's fundamentally sound.
And what I found interesting was how they achieved that 14%. It wasn't by loading up on debt, was it?
No, and that's absolutely crucial. That's the stability factor. They hit 14% ROE, but their debt-to-equity ratio was still under 2, which means they have a lot of headroom to grow further without needing to immediately raise more capital from the markets. Their longer-term goal is actually 15% ROE, and they plan to gradually increase leverage, maybe to 3 or 4 times debt-to-equity, before they think about raising more money. It really shows a focus on capital-efficient, sustainable growth.
Okay, so the big picture, the long-term engines, seems solid. The light bulb is definitely on. But now we need to check if it's flickering a bit, given that chaotic bazaar. Let's shift focus, put away the telescope, pull out the microscope, look at the near-term stuff, the challenges. Where are these risks actually showing up right now?
Yeah, and management was quite direct about this. They acknowledged they're in a shorter-term trough. A lot of this seems to be the fallout from, well, the whole industry may be having, as they put it, kept the bar open for too long after COVID, which led to the RBI needing to step in, especially on unsecured loans and microfinance. SBFC is now navigating the ripple effects of that cycle.
And they clearly stated they're not out of the woods yet. That tension shows up in the asset quality figures, right?
It does. Gross NPAs, non-performing assets, were at 2.77%. They called it range-bound, so maybe stable-ish. But the real worry, the thing they highlighted, is in the early delinquency bucket. We need to talk about the flow into what they call the 1+ portfolio, the 1+ DPD.
Okay, 1+ DPD. For listeners, that just means
Days past due. So loans where the payment is literally just 1 or more days late. It's the earliest warning sign. And while they said the intensity of new loans falling into this bucket has eased off quarter on quarter, the actual volume of loans entering that state hasn't completely stopped. They're still seeing more customers than they'd like hitting that initial hurdle.
But they are preparing for it. Provisioning seems quite high.
Oh yeah, very aggressive. The provision coverage ratio, PCR, is up at 46.17%. That's well above their target of keeping it north of 40%. But of course, that comes at a cost. Their credit cost for the quarter went up to 1.29%. That's the price of insuring against those potential losses.
Right. And what's really new, or at least more pronounced now, are these other risks they flagged, things beyond just typical credit cycles.
Exactly. This is fascinating. They explicitly called out 2 risks that they said weren't really on the radar, not to this extent anyway: political risk and climate risk. These bigger macro factors are now directly hitting portfolio performance.
Let's dig into the political risk one. They gave a specific example, didn't they? Karnataka.
Yes, Karnataka. It makes up, 11–12% of their total loan book. Apparently, it's performing really well, a strong portfolio for them, until suddenly, early this year, it got rudely shaken up, as they put it.
Rudely shaken up.
Yeah, meaning performance dropped off sharply and unexpectedly, all within just 2 months. And the trigger: a specific state-level ordinance that messed with collections and maybe the general repayment culture there. Now, fixing that specific issue, they reckon, will take several quarters. It just shows how a localized political or regulatory change can throw a wrench in the works, even for secured loans.
Wow. Okay. And the other area getting hit was the smaller loans, below Euro Zevalot.
That's right. That lower ticket size segment, which is often the most sensitive to any kind of economic pressure, was showing signs of stress.
So, faced with these specific pressures, Karnataka, the sub-7 lakh loans, what did they do? They tightened the filters, right?
Decisively. They took some very clear proactive steps.
Which involved 2 big moves impacting their immediate growth numbers.
First, they just stopped doing loans below 7 lakhs altogether. Just walked away from that entire segment for now. Second, they raised the entry barrier for new borrowers. The minimum CIBIL score requirement bumped up to 700.
Okay, CIBIL being the main credit score in India. So going from maybe mid-600s up to 700, that's a significant jump in quality requirement, like a club getting much stricter at the door.
Exactly like that. And you see the result immediately in the portfolio mix. Now, over 88% of their AUM is with customers who have a CIBIL score above 700. But the trade-off was real. Their rejection rates went up. And the bottom line: disbursement volume actually dropped by 6% compared to the previous quarter.
Right.
They consciously chose safety over speed in the near term. Average ticket size nudged up a bit, though, from 9 lakhs to 10.2 lakhs, which makes sense if you cut out the small stuff.
Yeah, that 6% volume drop really underscores the point. They're prioritizing the balance sheet health over hitting maybe a higher quarterly growth number right now. Seems mature, given the circumstances. Okay, let's flip back to the positive side. How did they manage those great profit numbers despite this tightening in the credit costs? Operational efficiencies must be key. They mentioned 2 big ones.
Yeah, 2 major tailwinds helping the P&L. First, on the funding side, cost of borrowing. Their new borrowing, the incremental cost, is now 80 basis points lower than what their average book cost was at the start of the fiscal year. For Q2 specifically, their overall cost of borrowing came in at 8.96%. When your funding gets cheaper, especially by almost a full percentage point on new funds, that flows straight through to profits.
80 basis points is significant.
Okay.
And the second efficiency, operating costs.
Yes, and this was arguably even more impressive. Their OPEX to AUM ratio, basically, how much it costs them to run the business relative to the size of their loan book, has dropped significantly since the IPO. It came down by 112 basis points, landing at 4.4% in Q2. That's a big improvement in operational efficiency.
How did they manage that?
It's classic operating leverage. Management used this phrase that their older branches are starting to sweat in.
Sweat in.
Meaning they're becoming much more productive. See, over 60% of their branches, out of 220 total, are now more than 3 years old. A new branch takes time, right? To build relationships, grow its loan book, cover its fixed costs like rent and staff. Once a branch hits that 3 to 4 year mark, it's usually running near peak efficiency. It's generating a lot more assets using the same fixed infrastructure. That leverage pushes the overall cost ratio down.
Ah, okay. That makes perfect sense. So cheaper funding plus more efficient branches helps offset the higher credit costs from this trough. The profitability puzzle is clearer now.
Exactly. And it allows them, even with the near-term caution, to stick to a pretty robust growth story.
Yeah, the guidance didn't really change much, did it? Still looking for 5% to 7% AUM growth quarter on quarter.
That's right. Which, still works out to a strong 25–30% growth year over year. So they're not slamming the brakes entirely.
And they gave some forward look on risk, too.
They did. They expect credit costs might tick up just a little bit more, maybe another 10 to 15 basis points from where they are now before peaking, which suggests they think this current patch of credit noise might last another quarter or two before things normalize. Seems realistic.
Okay. And finally, strategy-wise, any big changes in products or distribution?
Nope. Pretty much steady as she goes. They confirmed no plans, at least in the medium term, to add totally new product lines. They're sticking to their core. Secured MSME loans in that Euro lakh to 30 lakh range, plus their gold loan offering. Focus is key.
And distribution. Still leveraging the branches.
Absolutely. It's all about getting more out of what they've already built. Sweating those assets, as they said. Out of 220 branches, 185 already offer gold loans. And they plan to activate gold loans in another 15 branches over the next 6 months or so, just maximizing the footprint. So if you put it all together, what you see is a company that really gets the massive long-term potential in India's MSME space. Huge demographic, huge economic trend, but crucially, they're being smart right now. They're willing to sacrifice a bit of short-term volume growth. That 6% dip in disbursements is the proof to protect their balance sheet from the current market volatility. Keep the asset quality strong. It really looks like a classic case of prioritizing stability today to ensure they can capture that bigger growth opportunity tomorrow.
That sums it up perfectly. Okay, let's wrap up with that provocative thought that emerged from the call, touching on the regulatory environment. Management pointed out this difference. How long it takes NBFCs like them to resolve bad loans compared to banks, especially banks using specific laws like SARFAESI.
Right, the regulatory arbitrage issue. And just quickly, SARFAESI, that's the act that lets banks seize and sell collateral fairly quickly on defaulted loans, often bypassing lengthy court processes. NBFCs generally don't have the same fast-track access, meaning the recovery process can drag on much, much longer. It's not 3 or 4 times longer, tying up capital.
Exactly. Which slows everything down. So here's the final thought for you, the listener, to mull over. How much faster could the entire Indian financial system, not just SBFC, but all the NBFCs playing a vital role in credit delivery, stabilize and maybe even accelerate if that regulatory difference, that arbitrage, particularly around asset resolution speed via laws like SARFAESI, was leveled out? Something to think about. Thank you for joining us for this deep dive. We'll see you next time.